they were able to end QE, never were able to raise interest rates, but they're panicking now. They're going to start going down to zero. If they don't cut rates on July 31st, then it's going to be a bloodbath in the stock market. Absolute bloodbath. I think we're headed for a bout of stagflation like we've never before seen.
Join us for our next live stream this Sunday night, July 28th at 9 p.m. Eastern, where we will take a look at current events, some of our past guest views, and of course, gold and silver. Once again, join us this Sunday night at 9 p.m. Eastern, July 28th for our next live stream. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you have not already done so, please do subscribe to our channel, click on the bell to be updated on new content, and do give us a thumbs up if you like what we do. We appreciate your support. Our returning guest joins us today on SBTV, Michael Pento. Michael is the president and founder of Pento Portfolio Strategies, and he is a well-known money manager. He is also the author of the book titled The Coming Bond Market Collapse: How to Survive the Demise of the U.S. Debt Market. And we are delighted to have him here again as our guest. Good day, Michael, and welcome back to SBTV. How are you doing?
Thank you so much for having me back on, Patrick.
We're glad you're here again. Michael, we spoke with you regarding the inversion of the yield curve a few months ago when you were on our show. Can you give us an update on the inversion of the yield curve, and is the runway to the next recession just getting a bit shorter?
Well, the yield curve, parts of the yield curve are still inverted, and excuse me, but they did have a little bit of a spike between the 2 and 10. So the 2 and 10s came down to about 11 basis points a few months ago, and now it's about 23, 24 basis points. But I think that is because, Patrick, the Federal Reserve has assented that they need to lower rates, and they were no longer interested in hiking rates anymore. Remember back towards the close of 2018, we were going to go to 3.5% on the Fed funds rate, and we're going to be above neutral for about a year. That's what the Fed was claiming. Also, the draining of its balance sheet was on autopilot and was going to be like watching paint dry, and we're going to take the $4.5 trillion balance sheet down to around, say, $2 trillion, $1.5 trillion. That's all out of the window now. The balance sheet's going to stay probably around $3.5 trillion. And the Federal Reserve got to 2.25 to 2.5, say 2.4 on the effective Fed funds rate. And now we're heading back to 0%. And now I'm hearing from people like Charles Evans, who is the president of the Chicago Fed, that, hey, inflation, even though core CPI is up 2.1% year over year, inflation, according to Mr. Evans, is way below where it should be. And we have to panic now to cut interest rates by 50 basis points and then continue on from there. So we're only have 9 rate cuts before we're back to zero. And he wants to throw, 2 of them overboard right away, empty the chamber 2 right away, and then keep on going. So that's why the yield curve has started to spread out a little bit, but still inverted on major parts of it. And the countdown to recession, the countdown has begun.
Yeah, if I recall, at the end of 2018, the Fed was moving on up the interest rates, and then I recall Trump calling Jerome Powell crazy, and then kind of started sliding back down again. But with the U.S. presidential elections coming next year, do you expect the government and the Fed to sing Kumbaya and inject further monetary stimulus to keep the economy going, at least until the elections are over?
Well, that's a very good possibility. That's why I have a model, Patrick. So I don't just sit here and say, buy gold, short stocks, because someday you're going to be right, or buy China or whatever, short the dollar. I don't have any steady preconceived mantra. So I have a model, 20-point model, lets me know when it's time to go net short in the portfolio, when it's time to overweight gold, when it's time to overweight bonds, what factors should I invest in? Yeah. Should I go into momentum and high beta stocks, or should I be on the other side of that with low beta stocks? So what I see right now is we're kind of moving towards a more neutral stance in the portfolio. We have some shorts and we have some longs. I'm looking very closely at LIBOR OIS spreads. I'm looking at high yield spreads. I'm looking at break-even spreads. I'm looking at the economic data. So there's a chance. Listen, I mean, I'm humble enough to admit that I don't know for sure what's going to happen, a year from now. But here's some, some data for you. So, in 1995, the Federal Reserve cut interest rates a couple of times, one in 95 and a couple in 96, and the market was up, I think, like 140% after that rate cut. And we went into the boom of the tech boom. So that insurance cut, as it's now looked at, insurance cut was positive for the stock market. Okay, then advancing to 2001, the Fed cut rates in 2001 by a total of over 500 basis points. They did it again in 2007 by over 500 basis points. And guess what? The stock market the Nasdaq lost 80% in the year 2001 to 2003, and the S&P lost 50% of its value from 2007 to 2009, and home prices fell about 33% nationally. So, is this rate cut by the Fed going to be an insurance cut that leads us to a big boom in stock prices? I don't think so. But I'm watching the data very closely so I don't get caught on the wrong side of the trade. It could, is a small possibility. More likely, because we're not on the cusp of a major productivity boom from the internet. Asset prices are much higher today as a percentage of GDP than they were in 1995. And debt levels are much higher today than they were in 1995. So it's much more likely that the Fed is acting in arrears and doing rate cuts too little, too late, but stay tuned. You don't want to be on the wrong side of that. You certainly, Patrick, don't want to be short the stock market if it's the 95 cut. You sure as heck want to be out of harm's way if it's a 2001, 2007 event.
Interest rate futures traders, they're pricing in a 65% chance of a 25 basis point cut by the Fed this month.
I don't want to. Maybe we have conflicting data, but my data shows us a 100% chance of a 25 basis point cut, and a little bit less about what you said about 50 basis points, about a half percentage, 50% chance or so, but 50 basis point rate cut, 100%. So on Wall Street, if they don't cut rates on July 31st, then it's going to be a bloodbath in the stock market, absolute bloodbath, in my opinion, because they already priced it in. It's 100% chance.
We touched on this also, where student loan debt, auto loan debt, household debt, delinquencies, all going up. These debts, obviously, they're a drag on the economy, making it harder for it to get out of a hole. What if we just forgave the debt? What would the consequences be if we just decided to do that?
Well, the government is the owner of a lot of the student debt,
right? And
banks hold a lot of this other debt, credit card debt and auto loan debt. So I think it would be a devastating deflationary depression if you suddenly told the banks that their assets are worth zero. On the other end of that, government, you could just print more money, which I think this is what we're headed for. I think we're headed for a bout of stagflation like we've never before seen in the history of this nation. That's where I think we're headed. I mean, you think about it. I mean, one of the reasons why I think the Federal Reserve is panicking is because they have this asinine 2% inflation target. But that's not really, what good is a 2% inflation target? Why, if their mandate is stable prices, why in the world would they want inflation to rise at 2% per annum each and every year? It doesn't make any sense at all. But they're panicking now. They're going to start going down to zero. But the reason is because every other nation on earth now is panicking too. You have the ECB. They were able to end QE. Never were able to raise interest rates, but they were able to end QE. But they're going to go back into QE now. Japan, feigned an interest of maybe starting to thinking about ending QE. They never even tried to get close to ending QE. So they have a negative deposit rate. As the ECB, they're still in QE. They're going to increase the amount of QE. ECB is going back into QE. So if we're sitting here on an island raising interest rates, or at least holding the line on interest rates, then our dollar would surge higher. And for some reason, people no longer appreciate the benefits of having a strong currency. They also want to make sure they rectify that disparity in the yield curve. So that's the real reason. But when you get down to the real truth behind why they're lowering interest rates, if you really want to know why, is because they understand that if they don't maintain this 2% inflation target, that bank assets could start to go down again. That the housing market could start to crumble again. Stock prices can crumble again. Junk bonds would crumble, the price of junk bonds, and that would wipe out the banking system. So we're stuck in this hyperinflation of asset prices, and they're so petrified that things could correct, because if they correct, the leverage in the system is so great that if they even started to correct a little bit, that would turn into a massive crash very quickly. That's the danger. So they're out there trying to print and borrow and spend as fast as they possibly can. And I don't think that's going to end anytime soon.
In your opinion, what do you think is going to ultimately prick that bubble?
So there's two things that, I mean, on record saying there's two things that would prick this bubble. One would be a recession and the other being inflation. And you could actually get both. You could get inflation and a recession together, which is stagflation, which would be perdition for these bubbles. So you think about if you have a junk bond universe that's worth about 5.4 trillion, if you add in leverage loans and triple B debt, which is one notch above drunk with very, very little covenants at all. So $5.4 trillion of leverage loans, junk bonds, and triple B debt. That compares to 1.5 trillion of the subprime mortgage debt that went bad in 2007 and crashed the whole global financial system. So what would happen is that if you have a recession, those bond yields would start to spike because these companies would be going out of business. So they're petrified about a recession. However, what if you also get inflation thrown into the mix? So the two things that the junk bond market would really, really hate would be a period of time where the credit quality of these companies erode, sending rates higher, and at the same time, investors demanding higher interest rates because inflation is starting to spike. And that's a very real outcome of what the Federal Reserve and global central banks have wrought upon these nations.
Going back to 2007, mortgage debt and its derivatives, are they still a threat today?
It's the nucleus of the crisis is no longer mortgage debt. Banks have raised a lot of capital. I think the nucleus of the crisis is that junk bond market. That's where you're going to find the nucleus of the next crisis, because a lot of this debt was taken from the banks and thrown on central bank balance sheets. So that's a basic way to think of that is that the danger there is they've ignited a tremendous amount of dry tinder for inflation. They've left that base money. So just to be, I don't want to get too far in the weeds, but when the central bank printed all that money and bought all those collateralized loan obligations, CDOs, and all these bonds from the banks that were insolvent, they sat on the central bank's balance sheet. They were supposed to someday sell them back to the public and back to the banks, and taking those dollars out of the system. Those dollars are remaining in their system. So that's dry tinder for the next bout of inflation. So you do have a very elevated chance of a recession and inflation destroying the bond market. The corporate bond market is where all of the danger lies. I mean, that's not to say that there isn't a danger in the housing market. We have an echo bubble in the housing market. Home prices if you look at home price to income ratios, they're back almost to 4. So there was 4.3 at the peak of the bubble. That ratio should be around 3.3. So home prices are in an echo bubble. So they're very vulnerable to another crash again. The national debt now is over 22 trillion. So there's productivity problems, there's growth problems in the nation. Household debt is at an all-time record high, not relative to GDP, but at a nominal high. So, if you have a very strong GDP growth number, that kind of masks, I think it's artificial, but that kind of masks that ratio, ameliorates that ratio. But you have problems all over the place. But the salient nucleus of the issue is in the corporate debt sphere.
Okay, corporate debt. But do you think this coming crash, will it change the standing of the U.S. in the world? I mean, do you think this crash will bring us a new superpower where some other country is going to emerge in place of the U.S. as being a superpower?
No, I think that instead of the U.S. being superseded by, say, China, as the world superpower, or Japan or Europe. I think the U.S. is going to come down to where all of those other nations are. That's what I think the most risk lies. Not that the U.S. is going to lose its premier place as the world superpower and the preeminent superpower. I think that it would be more like we are going to become like Europe, Japan, the Japanification of the world, and that's very sad.
Yeah, I guess that song, I think I'm turning Japanese, might become a reality, huh? But you were on RT with Max Kaiser a while back, and you said, "What's wrong with recessions?" And it seems that all recessions are outlawed today. Can you elaborate a little bit on why you said that there's nothing wrong with recessions?
Well, here's the thing. So in 1913, we came up with the wonderful idea of the Federal Reserve System, which is supposed to be an emergency lender to banks. So it's the banker's bank, so to speak. And what they did is they were supposed to kind of like tinker around the edges of in the money market. So if a bank was in jeopardy, you can go to the discount window and take a loan out at a penalty rate. And that was it. We weren't supposed to be in the business. We, being the Federal Reserve and governments, were never supposed to be in the business of manipulating asset prices in perpetual bubbles. They weren't supposed to avoid recessions and to abrogate the business cycle. But in 1913, we started down this road. It was exacerbated in 87. It got worse in the late 90s, and in 2000 and 2007 and 2008, it rose to another crescendo. And now today, I mean, it's completely insane, Patrick, where, central banks now, and this is shocking, but this is the truth. So not only, I'm sure you are aware that there's $13 trillion worth of sovereign debt that has a negative sign in front of it. I'm sure your audience is aware, but if they're not, they should be, that there are junk bonds in Europe that trade with a negative sign. Now, I mean, when you have that, when you have a corporation issuing a bond, a corporation that is highly likely to default on its principal, and you own this bond, not only with that risk in mind, but you're actually losing money. You have a negative income stream from this corporation. This is beyond the twilight zone. And yet, we now hear that the ECB is going to be increasing through its next iteration of QE the amount of corporate bonds that it purchases. Patrick, where does this all end? I mean, that's why, see, the bubble in the bond market is the supernova that's going to explode, because someday you're going to get either a recession or inflation. I don't think the central bank may be able to hold a recession in abeyance, but I do not believe that the central banks can hold inflation in abeyance, precisely because that's their goal, is to create inflation. So either one of those two things blows up the bond market, and when that goes supernova, watch out, because that's going to take every asset down with it.
Judy Shelton, nominated by President Trump to be on the Fed board, she mentioned something along the lines of having a sort of treasury that would be convertible to gold. What's your take on that?
Well, I love the fact that Judy Shelton espouses a gold standard. Yeah. However, she was interviewed by Trump, and Trump received the information from Judy Shelton that if she was elected onto the FOMC, that she would cut interest rates immediately. Now, I find it hard to believe that if we were living under the auspices of a gold standard and the strictures of a gold standard, that cutting interest rates would be the right prescription for today. I can't reconcile those two views. But going on a gold standard, this country was on a gold standard ever since its formation. Yeah. We started to go off of it in 1913. But any argument against gold is totally ignorant of history. This country had an industrial revolution. We had stable prices. We had recessions. We had minor depressions that were quickly rectified because we kept that base money supply commensurate with, or nearly commensurate with, population growth plus productivity growth. And where's the argument that when we went off the gold standard in 71, is there an argument to be made that stable prices were the result? So the stagflation of the 70s, which is a result of going up the gold standard, that was stable prices? Was the collapse in stock prices in the NASDAQ bubble, or the housing bubble and the equity bubble in 2007, was that an example of stable prices? We have below trend growth for year after year. Is that an example of a permanent condition of prosperity engendered by going off the gold standard? I mean, look at the mess. Now, I said we have Austria. I forgot to mention, we have Austria that issued a 100-year bond that yields 1.2%.
Oh,
I mean, in what insanity world, what insane world would that have ever taken place? Who knows what's going to be the inflation rate? So you're a buyer of this bond. You know what the inflation rate in Austria is going to be 100 years from now. I mean, you're almost guaranteed to lose after tax. So every investment is measured by what your income is after taxes and after inflation. You're almost guaranteed to be a negative in that scenario.
Yeah, I hear you.
And you've locked your great grandchildren too.
Given the crisis on the bubble that we were talking about, do you see gold right now as an attractive asset to hold, and why?
I do. I have a 20%, which is highly unusual for me. I have a 20% allocation in the portfolio to physical gold, precisely because the game is over, Patrick. The game is over. Central banks can no longer pretend that they can normalize interest rates. You know, central banks went on record saying that this was a one-time emergency operation in the wake of the Great Recession. So in 2009, we had all kinds of emergency measures deployed. Yeah. And we were never supposed to have, we were supposed to go back to $250 billion annual deficits. We were supposed to be able to normalize interest rates. We were supposed to drain the balance sheet, and none of that has. We're back to $1 trillion deficits. Interest rates are headed back to zero, and the balance sheet, the central bank has permanently monetized, over $3 trillion, $3.5 trillion will be permanently monetized. So that's it.
Yeah.
So that's why, if you're living in a world where nominal rates are zero and below, gold is no longer like a luxury. It's mandatory in everybody's portfolio. Yeah, gold and silver. Actually, silver's doing. I mean, I've never owned silver before, but I mean, if we're headed for this type of stagflation, maybe that's a part of your portfolio. It should be a part of your portfolio as well.
Michael, before we wrap up, can you let our listeners know more about what you do and how they can find your work?
So I have a website, pentoport.com. My email address is mpento@pentoport.com. You can come to the website. You can email me with your questions. I have a podcast that's $49.99 per year, which I give you the real truth about what the economy is doing. I also manage money here. Also, if you have around $100,000 minimum to invest, I'll make sure that, or I will try my best to make sure you're not only protected from the downside, but you can also have a chance to profit from it, because it is going to be an epic crash when it finally arrives, unfortunately, for most.
Michael Pento, we thank you for coming on the show. It's been a pleasure speaking again with you, and hope we can do this yet again another time.
Okay, Patrick, take care. Thank you so much.
That was Michael Pento, president and founder of Pento Portfolio Strategies. For more information of his work and his views on the economy, please visit his website, pentoport.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.